Another day, another episode of the world's number one commercial real estate podcast, the Lone Star Capital Podcast. Your host, Craig McGrouther here with Lone Star Capital, the Director of Business Development, with a little pep in my step, because why not? And the one, the only, two-time author of 50,000 copies sold of his two best-selling books, the CEO and co-founder, Rob Beardsley. How are you today, my friend?
I'm good. It's a great Monday.
It's a great Monday. Just want to start with a couple of things here. Number one, to all those who are affected by the hurricane in the Carolinas and wherever that is the week before, our thoughts are with you. If you're looking to figure out how you can get involved and help out during these awful times where people literally lost everything, I think we should have in our show notes. I'll send it to Kurt to put in there. But Chris Larson, our great friend and partner, has been spearheading an amazing fundraiser where he is legitimately donating every bit of his time out of his busy life and schedule as a father of some children, as a husband, and works a strike mission to really help people who are in most need pertaining to the hurricane reliefs in the Asheville area. He is from that area, and quite literally he mentioned that he's like, Craig, I'm just not sure that people even have anything left. Like, the city got washed away in some spots. Some towns outside of the two might be gone like literally forever, and that's not even hyperbolic or hyperbole. It's true. So if you're looking to get involved there, we'll have that link, hopefully the donation link in there. So I personally donated. I believe you donated on behalf of the firm. My incredible and beautiful girlfriend also saw the link and auto donated. Didn't even have to ask her about it. So she's a real one. We love her. Love you. So thank you so much for people doing that. And obviously, if you want to get involved, there's how you do it. And then in addition to that, it hasn't happened yet, but it's coming this week, it seems, the hurricane coming up in Florida. So our thoughts and prayers with our friends who are being affected out there. Shout out to our buddy Sam Silverman, who is in Tampa right now. And I think he's moving to Miami in a bit, not to dox him in the city he's in, although you probably would like that anyways. He is there and is bunkering down. Honestly, thoughts and prayers, as it says, to everyone who's affected there. You are certainly what we're focusing on right now in our thoughts. So yeah, it's never fun to start a show like that, but I just wanted to kind of express that, you're there as I sit in Phoenix where it's just oppressively hot. Not having to worry about things of that nature is really something that I didn't really even think about. I don't think about that being from California, as you are too. You have earthquakes to worry about. But just thoughts out to the people that are affected and everyone there. I hope you're doing great. Okay, moving on to what's next for us, just housekeeping. We're going to be in Miami, which I need to, as a reminder to myself, start sending out emails, set up appointments, meetings, people of that nature. That is my job as the Director of Business Development. But we will be at Miami for the Ascent Conference. We get in November 2nd. We'll be there till November 6th. And then we'll be in Tampa Bay, Florida for Sam Silverman's event. Shout out to our great friend, a friend of the pod, a friend in real life, a friend to everything that we do. He will be having his fully funded event. This is an unpaid ad that I'm giving him a free ad here. But go to his event. He just sold out VIP tickets, which Rob and myself will be there for. And we're looking to meet people that are there. So if you are going to the fully funded event coming up in November, I think it's the 7th and 8th, we will be there. We want to meet with you if you're a capital allocator or an LP investor. Looking forward to doing that. I've never been to Tampa Bay. I've only been to Miami once, I believe. So I'm excited to do a little SoFlo trip coming up here.
Yeah, it's going to be really cool.
Yeah, awesome. Well, let's get right into it, unless you have anything else you want to add. Do you have anything else to add, or should we just start ripping?
No, let's go for it.
Very good. So we had a thought here, but we went really long last week. So on the kind of debt conversation and, what to use, what not to use, and how to use it. But one thing we wanted to talk about, and this is your idea, which I love it when you have something that you want to speak on, because it means you're probably going to have a lot of passion and enthusiasm, which is working with different levels of sophistication for investors. So the floor is yours, my friend.
Yeah, so as many people know, we work with a diverse range of investors, ranging from people who know very little about commercial real estate and are investing, let's say, $50,000 at a time, and they're just a high net worth individual, then ranging up to smaller fund managers or fund of funds, co-GP partners, family offices, private equity firms, JV partners, kind of the whole spectrum. And something that we've all learned working with a very diverse group like that is you really get to know the way that different partners work. Some are very relationship driven and they want to meet you in person, shake your hand, get to know you, and they're really investing in the jockey. And then others are wanting to just dive into the numbers and underwrite the deal a million times and ask a million questions. And everyone's got their different style, which is perfectly valid. One thing that's interesting about the difference between more institutional investors versus call it retail is the kind of the lead time and the way that the deal changes. That's what I want to focus on, because we all know that when you originally spot a deal out in the wild and you go tour it for the first time, you underwrite it for the first time, you get it under LOI, then you go under contract, then you do due diligence when you're under contract. All the while, interest rates are going up and down, and the Fed's saying this, the Fed's saying that, and there's just so much that happens throughout this whole period. So we all know that deals can change dramatically from the time that you first lay eyes on them to when you actually close. And when I say we all know, we all may know it, but frankly, JV investors, they get it and they're in the business, so they're more accustomed and comfortable to change, whereas change can really rattle and throw off more retail investors or passive investors who aren't really in the business day in and day out. And unfortunately, those types of investors can perceive change to be risk, right? Risk equals change, or change equals risk rather. And that's something that we need to be careful about when we are talking with certain investors. We need to know our audience. And so while it's totally fine to talk to a JV partner and say, oh, well, rates went up and now the debt is different, or we did due diligence and actually we're going to budget a little bit heavier on the roofs, and so we're going to shift some things around here in the business plan, and that's really not such a big problem. But if you have your numbers start to change with like a retail investor, they could get spooked and go, oh, well, this group doesn't have their ducks in a row, or whatever they can start thinking. So I think this is kind of just like inside baseball for people listening, that it's really important to know your audience when you're pitching a deal or you're looking to get an investor to come partner with you, and you just need to know, what are they looking for? Are they looking for kind of smooth and steady? Are they looking for cash flow? Are they looking for IRR, equity multiple, and things like that? The other big fundamental difference between kind of like a more sub-institutional fund manager versus a JV, and I think you'll appreciate this a lot, is the fact that when you present a deal to a JV group, it's a negotiation. When you present a deal to like a fund-to-fund or a retail investor, you're just kind of giving them an option, and it's a binary option, yes or no, invest or not invest, right? And so on the negotiation side with a JV group, you're presenting them a deal, you're giving them the pitch, you're showing them the numbers, and then it's up to them. Obviously, at the end of the day, they're going to make a yes or no decision. But before that, they're going to be making yes or no's about your assumptions, about your business plan, about your debt. And so they might say, you know what, I don't buy your exit cap rate, so we're going to widen the exit cap, we're going to tweak the vacancy rate, right? These investment groups are used to having firms go and pitch them deals, and pitch them deals aggressively. And so they're used to taking the numbers that the sponsor presents and then backing them down. It's almost like a choreographed dance or a habit. So it's really important, more inside baseball. If you're a sponsor looking to attract institutional money, I know it sounds kind of weird, but you actually need to be aggressive with your numbers, because you know that the JV group is going to back your numbers down. And if you like, hey, I don't want to play the game, let me just show them real numbers and be more realistic, more conservative, guess what? The JV group's still going to knock your numbers down, because they have it ingrained in their head that you're an aggressive sponsor, and whatever you show them, they are already going to be trained to back it down. So you're not going to win any favors by being more conservative in front of a JV group. Now with retail investors, 100%, it's a totally different strategy. So I think this is actually the big crux of the matter, because something that we in the past have gotten bogged down by is we get a new deal, we're all excited, we put the memo together, we put the deal package together, and then we send it out to various partners, whether it be sub-institutional versus institutional, and we're showing them one package, and then it's like it's not going to be tailored to both perfectly. It's impossible to be tailored to both, right? And so sometimes in the past we've tailored it to more of like a joint venture audience, and then so we show it to the retail group, and they see kind of like more aggressive numbers and they get all excited, and then later when we finally finalize the deal and the numbers are more back down, they get deflated or they're confused, like what's changed about the deal and whatnot. So it's really, this whole thing is actually quite tricky, which is why, going back to my point, it's really important to know your audience.
I have a lot to unpack there, and I thought it was a great kind of just stepping stone to launch into the conversation here. So let's go to institutional investors. And I just listened to Tyler Lyons' podcast, which he texted me kind of in review, Cash Flow Chronicles, I believe it is, Hunter Thompson and Tyler Lyons with ASIM Capital. We love them. Hello. Probably not listening, but hello. But they mentioned something that's really true, which is how institutional investors look. And this is kind of what one of Tyler's takeaway was, is they look at deals, and this goes to your point, at a more holistic level. So what that means is, hey, location, basis, maybe not so much interest rate sensitive, debt sensitive, because maybe if they're going to do a deal, they're going to probably scrap what you have there together and probably have a little bit more say so on the final numbers there, the leverage points, where they feel comfortable, where they think the alpha is, and what their investor committee can push through. So they're going to, as you kind of mentioned, they're going to look at deals more holistically. Is this below replacement cost? Is this positive leverage? Things of that nature. What's the income growth like? What are the trends like? How is this deal, cap rate wise in relation to other deals in that said market? So they're going to go there. But what they're also going to do, to your point, is they're going to take what you sent to them, knowing that projections are just not lying, but it's just projections. It's not set in stone. They're going to basically deconstruct your entire model and likely put it into maybe something that they have that's proprietary, right? Of course, at Lone Star Capital, we have our, proprietary model, which you wrote the book on. Quite literally, it's your model. And I can't tell you how many times we go to conferences and people come up and say, oh yeah, I've downloaded your model and I use it. But I would say, generally speaking, if you're talking to a sculptor or Torchlight, one of these, really big Pennybacker, one of these really big institutional names, highly legit, Wharton guys, Ivy League people all over their staff, they're going to have their own model that they do that they're going to put in there, and they're going to really just gut test it. If you have a 5.5 exit cap rate, well, guess what? We ain't saying yes to this in this deal right now. We're not going to do common equity. Maybe we'll do prep, but we're not going to throw common at you unless this passes at a project level 13 or 14 IRR at a 6.5 cap, which is maybe a whole basis point or whole point of expansion on the exit cap rate, right? And I see your rent numbers. Yeah, we're going to put them at 1% as a base case because maybe they don't believe in where the property is, and if it checks there, then and only then maybe you get to the next steps in the conversation, negotiating price and terms and things of that nature.
Yeah, and not to get sidetracked, but the funny thing is it's so hard to get your first deal done with a joint venture group, and they're going to find every reason not to do the deal. Like you just pointed out, rent growth assumptions, exit cap rate assumptions, pro forma rents, rent comps, expenses, location, everything, right? There's so much that they can just use as ammo to shoot down your deal. But then the funny thing is once you get a first deal done, you get through their investment committee, and then now they want to do a deal with you. Then you see that they're looking for every reason to do the deal. And so everything always, at the end of the day, boils down to relationships. But to your point, they are super sophisticated, so they know exactly what they're looking at. So it doesn't really matter. Like, you're not going to quote unquote trick them into doing a deal just because you use a aggressive underwriting cap rate or what have you.
Their boards are likely, could be double your age. It's a lot of, years of being in the real estate business for the brain trust that you're going to push that through to say yes to the ultimate decision maker there, if you will. Managing directors will push it there. They'll give you your case, but then it's the IC investment committee that will finally push it all the way through. So just holistically speaking, if you're a sponsor or if you're just curious to know, that's how it kind of functions at a high level. The other thing with, levels of stories and stuff, investors, I tipped my word, is story. Why does story matter? Why is story so crucial? Well, the reason why is because if you're bidding on a market rate deal, guess what? You paid the most. And you know what they could have done? They could have bought it too. They could have paid the most as well. So why do we need you? Why you? what's going on here? What is the value add that you're giving me that I can't go with, basically slapping on a big brand, big box, third party management group here? We'll just take all the upside for ourselves and our investors. We don't need to employ you. So that's why everyone loves this story conversation. And I fully understand it. I think the more I get into the business, I may slightly disagree because I'm biased to our own book and our own pocket in a sense where I know how great we are. But of course, time will only tell. The proof will be in the pudding ultimately there. But with that said, the story is such a crucial component and element because they need to basically be able to tell their investor committee and not be annoying to their IC, like, all right, this guy's a schmuck, like, get this guy out of here, he can't vet a good deal. They need to hear the story as to why you got awarded this deal. What is the alpha that you're providing here that we can't get ourselves? So with a lot of market rate deals recently, it's kind of been tough. But with, an angle we've been able to have is how are we different and how this deal is different? Well, a couple deals that would have felt for those buckets is the tax exemption structures that we have. Now, we're not the only shop in town doing it, but we do it at a very proficient level, and we can truly provide unique alpha there by eliminating one of the other biggest expenses. The other way we've been able to kind of convey story, just talking our book, is unwinding the baby REIT structure, which very few groups have the wherewithal, the ability to do so. You need a lawyer in-house to speak with the lawyers to do it. And of course, Kent fills that bucket there. So it's a lot to think about there. The story conversation at first kind of maybe didn't trigger me per se that's strong, but I thought it was a little bit silly. As time has progressed, I see that point of view. I see the thought there. And that might just be the reason why, sometimes we just don't do deals with some groups because it's just a nice market rate deal. And sometimes there's nothing wrong with that. Hey, this fits nicely into our portfolio. We get economies of scale benefit. This is 2 miles away from, 1,000 units we have. That's a good story for us. Hey, this property's here. Maybe it's a little bit mismanaged. Maybe there's a clear path to value creation if we put in $10,000 a unit and we can get $200 rent pops. That's awesome for us, a nice value add deal. But moral of the story is very important. No pun intended. But the story is very important to a lot of these groups. And I know we've had these conversations, so I'd be curious to hear what your take is on that.
Yeah, the importance of story is kind of built up on the premise of the efficient market hypothesis, right? Because and the efficient market hypothesis is pretty true. It's not like there's markets or deals that are overlooked, right? There's plenty of buyers. There's plenty of people that are looking to buy good deals and make money. And so it's very rare that you're just going to be able to stumble onto a great deal without a story behind it, right? And so that's what people are looking for, right? Savvy investors know the fact that you're most likely not going to get a great deal just kind of happenstance. So they want to know the story behind the deal. Like, is this the 10th time that you're buying from this seller and the seller really trusts you and so you were able to bid not as aggressively and you weren't the highest bidder? Or like you said, the bidding was less competitive than a normal marketing process because the deal was subject to a REIT acquisition, and so that scared off a lot of the competition, so we were able to pay less. There's lots of ways that a deal can have a good story, and yeah, it's actually really important that you do have that story because at the end of the day, everyone is looking for a deal, right? And what is a deal, right? A deal is not just a project, a property, right? A deal is, hey, I'm getting something good here. And that's the essence of the meaning behind the word deal.
A
And
deal is outsized. A deal is you're giving me something that I can't do myself. That is what a deal is. If you really boil it together, for those who are wondering, a deal is what are you giving me that I can't do myself? Why do I trust you with this firm's dollars? That is what a deal is. Not I have a deal I'm raising for. It's no. Why is this the deal?
exactly, yeah, it's a really good point because yeah, I mean, we kind of covered the subject, but these
So
private
let's
equity
go.
groups, they could just call up Berkadia and they could pay the most and they could hire Graystar and Graystar would manage the deal and they would have saved themselves on fees and promote. So for a private equity firm to want to pay a sponsor like us fees and promote to do a good deal, we need to bring some value to the table. And that's where we strive to do so via unique opportunities, relationships, deal structures, business plans, right? Sweat
Mission
equity.
driven. Yeah.
Yeah.
And then I'll say the other side of that is, our in-house investors. We call them retail investors. We've got several of them that listen to the show. So the interesting thing about, our in-house investors or just investors generally and just to sponsors, I can really speak to more than our people here, but What they can kind of struggle with is if we sent them the deal on the first wave, for instance, and then numbers change, well, the number and the cake isn't fully baked yet for the better or worse. And unfortunately, over the last 18 months until recently, there's been a little factor that's really kind of disrupted and blown everything up. That factor happens to be debt increasing at a historically high rate. For instance, that can really compress your cash on cash return. So if debt goes up, a whole point or 50 basis points, that might take your cash on cash from, let's say, 5.5%, 6% to a full basis point off or a full point off. That might take the deal from a 6.5 cash on cash return to a 5% cash on cash return. That is a materially different story and song there. And a lot of investors right now are investing for cash flow, or maybe they're looking around and pondering their opportunities and they're saying, okay, well, I can invest in this Lone Star deal in a common equity position, and I'm getting, call it a 5.5% cash on cash return. But I can just debt invest, maybe make 10%, and it's more of a cash on cash. It's obviously taxed differently, but it's a different risk profile. So that's something you have to be mindful of if you are, in fact, a sponsor. And just, when how we handle our processes, who gets the deals first is typically speaking our, capital partners, our boutique, fund managers, capital allocators that, can raise, $1 million. And then also, of course, before them, or maybe usually in tandem now, I would say these days are our JV relationships, family office relationships. Because if a number changes here and there, they're not investing purely because of XYZ metric. They're looking, as I mentioned before, holistically. So that's kind of the story there. And it's just really brutal when the numbers change in our face. It's not like we want to dumb the deal down or water it down. Heck, I wish I could give you everyone a 9% cash on cash return and a 17 IRR in every deal. Who wouldn't want that? That cash flow is probably tax free. But unfortunately, that's just not really how the world works.
Yeah, it's not.
Yeah, and then timetable as well as the other thing too. Timetables will change and vary. Joint venture equity groups that are, the single ticket or single check writer, maybe family offices, they need a lot of time to go through this process. They need probably 60 days. And the concerning thing about that is, hey, 60 days, well, if we think we're going down here and you pull out last minute, that leaves us with a very big hole that we need to fill. So, and it's tough to say yes to that at time to time when you factor some of our other people that we work with, some of our fund managers who I was just speaking with people literally all day on the phone today. If you look at my call log and my phone usage, it's disgusting. I lead America on phone calls. But spoke to them and they can give me yeses in basically 72 hours to raise a meaningful amount of dollars. If we're raising $15 million, like this new project we're kind of going on, reach out to me if you want to learn more. There probably is no space by the time you reach out if you're a fund manager looking to go into the deal. But that said, I can speak with them. They can talk through it. It checks a couple of boxes. They're ready to raise $1 million, ready to go. And that's a massive benefit. And that's something on our end, we get a couple of those stacked up with some of our kind of key premier people, 3 million here, million there, 500K there, 2.5 there. Next thing we've got $10 million and we only have to look for a couple more million on top of what we're going to raise in-house from our retail in-house investors. So just the timetable is a very interesting conversation as well as we go through and embark on this point of the cycle and whatnot. There's obviously a lot of negativity going on, but there's also a ton of positivity and people that are ready to go and that are gung-ho.
Yeah, I think we've covered this topic quite a bit historically, but this speaks to the disintermediation of the private equity space that has been happening since 2012 and the Jobs Act. And I think this is just a trend that's going more and more and more because institutional capital, the middle market, it used to be like $5 million check, right? So you'd go to a joint venture group and they'd say, yeah, we write checks of 5 to 10 million. Well, now a lot of them are writing 10 to 25 million, 15 to 50 million, right? And that's still kind of middle market. And that's great, but it's also reflective of the fact that groups like us can now syndicate larger checks in lieu of doing a joint venture deal, right? Like we wouldn't even do a deal that's $5 million of equity. So it's like things have just shifted up. And I think as things shift up, it's kind of squeezed the JV guys because they are struggling to find places to go because they want to play in the middle market because the middle market is where you can get opportunistic level returns where they can charge double promote and exist, right? And the problem is they're getting so big, they're kind of almost outgrowing the middle market space. And if they have to write checks that are bigger, and because that's their fund size, and because that's where they're competitive, because the sponsor will only go to them for kind of bigger checks, because otherwise they'll just pass the hat around. Well, those size deals don't offer opportunistic level returns, and then they can't really justify their existence and charge a double promote, and so it doesn't really work. So I think that's kind of like a very long ranging macro problem happening, but we're on the right side of that trend. It's a really beautiful thing for us because we're on the road to scaling with our partners to do amazing things, amazing deals, and the added benefit of being able to 1031 exchange together. So we're more tax advantaged than in a joint venture structure. And so I only see that continuing to grow and grow and grow.
Yeah, and how we want to do is and just if you are a JV person listening to this, tuning in, hi, hello, email me, DM me, you know how to get a hold of me. But with that said, that's not to say we're going to be limited moving forward, but if we've done well on a deal and that group is ready to 1031 exchange with us, well, correct me if I'm wrong, but that equity is probably lined up ready to go. Maybe we'll splice on a little bit more here and there. We're ready to ride on that next one. So we can really get to scale. Perhaps we get to scale via doing that and then also and stacking in tandem with another deal, and maybe they give us a JV check there, we get scale that way, assuming they like the opportunity. So there's a couple ways to do it. There's no right or wrong. It's just it's got to make sense for all parties there, to your point. But as you overheard me on the phone with one of our awesome partners, shout out to him, maybe you're listening, maybe you're not, but with that said, he raised about $3 million for the Houston 3 property portfolio. And in concept and in theory, if that deal does as it performs, he might have about $5.5 to $5.4 million of basically equity raised from the projected numbers. And this is a big if, but if it does that, he's raised $5 million by doing nothing if they just stay in the deal and go to the
Yeah,
next.
that's right. Yeah, yeah.
Yeah.
Explain the
So
because not a lot of people don't understand that it's like pre-raised already, basically.
Yeah. So what I mean by being pre-raised, thank you for catching that there, and I'll break it down, is if we go from deal A to deal B with Lone Star Capital and we 1031 exchange this deal, we do well, do a tenancy and common structure into the next deal. Now they can't go from, Lone Star deal A to different sponsor deal A. They would have to stay with us in that deal, or they could cash out and pay the taxes and the gains. But if they go with Lone Star deal A to Lone Star deal B and their investors stay, a nice bulk of them, and the deal does what we're projecting, that 3 million turns into 5.5. Well, that's the equity lift there going into the next opportunity. And if they say yes to it, well, now he's just raised $5.5 million technically because it stayed in the deal. How can you not love that? How can you not romanticize real estate and getting into the game if that's what's going on there? Your work, if you can get through it now and you raise new funds on top of that, next thing you know, you do that for a decade. And you heard this too. It's like, well, now you're managing $50 million. That's pretty sweet if you ask me. So it's just, this game is very interesting. If you can get to scale and really tough it out there, you're just going to have a really, really incredible staple of equity. And if you just do the right thing, take out the lever points, you make it through these tough times, you springboard into the new economy and the new cycle very well.
Yeah, that's what we're building.
Yeah, and segueing into some other stuff that I found to be interesting on that topic, I was forwarding you some feedback from some groups, from a deal and whatnot of late, and one of the interesting feedbacks is, and this is also through the conversations I was having, at our summit, of course, which if you missed out, that's too bad. Only great feedback from it, but from what institutional investors are looking for right now, and this totally makes sense, which is a strong focus on cash returns. And I think the reason why that is the case, and I'll let you go off after, but my hunch is the thought of, look, I can't tell you where cap rate expansion is going to go. I can't tell you what new supply in this market may or may not look like. But what I can tell you is that cash in the bank and cash flow into this deal is real, materialized. And if we can get to almost clearing up that pref number, if it's, call it 7.5 to 9%, well, that makes me really excited. And any appreciation on top of that is great.
Yeah, I think institutional investors have just really, really struggled to put equity out for commercial real estate because of fear and because of opportunity cost. With as high of short rates we've had, it's been very compelling for groups to sit on cash and make over 5% on their money. And the idea of investing in a risky real estate asset as opposed to risk-free bonds per se, or let's say, and make a lower cash on cash return, that's a very tough pill for them to swallow. So also, if you're talking like real institutional money, like pensions, these are tax exempt investors, so they don't need the tax benefits associated with multifamily investing or commercial real estate investing, right? So they're comparing straight pre-tax return on
Yield.
short-term bonds versus pre-tax return on commercial real estate. So it's been a really tough environment. So yeah, I get it. I think it's like a little short-sighted because short-term yields are not here to stay, right? The Fed already cut 50 basis points. Fed's going to probably cut 25 basis points in November and then cut again in December. Let's just ignore the 250K job report that just came out. But short rates are not here to stay. So people are going to be searching for yield one way or another. And that's kind of one of the big things that happens when the Fed cuts rates is it forces people further out on the risk curve. And they're going to take more risk by way of longer term maturities for bonds, or they're going to take risk as far as credit, right? Instead of buying government bonds, they buy investment grade. Instead of buying investment grade, they buy junk, or talking about going into privates, the whole spectrum of risk, right? So that's going to spur more investment. And also, people have been sitting on their hands for too long, right? People want to invest. One of my favorite quotes, actually, that Peter Linneman says a lot, and I'm assuming you already listened to the new Willie Walker Linneman video, but he talks about how institutional groups are paid to take risk, right? They're just not paid to take risk when other people aren't taking risk, right? And that's the period that we've been in. We've been in this period where, like, yes, all these groups are sitting on billions and billions of dollars and they're paid to go take risk with that money and go invest it, but they're not paid to take risk when everyone else isn't. So we're going to finally get past that point and it's going to be like all or nothing. Like right now it's nothing, and then it's going to all come back and everyone's going to be investing again, and all at the same time. And that's why Peter Linneman, in that Willie Walker webcast, that alliteration is crazy, he thinks that cap rates are basically going to compress like 75 basis points over the next year, which is insane. And I'm okay with that so long as rates move lower in lockstep, if not more, right? That's what I'm really hoping, that we see some good positive spreads available, positive leverage available between cap rates and the cost of borrowing for quality real estate. But I digress. So anyway, that is that's kind of the challenge that people say. So long story short, I know that's a lot of rambling. When you're getting the feedback, people are looking for cash on cash. Like, it's just, in my opinion, it's just the latest trend for institutional investors to find a way to pass on the deal. They could pass on the deal because the cash on cash is too low, or they could find a way to pass on the deal because the IRR is too low, or because now's not a good time, or whatever it is. Like, they just have their own bugaboos, and they're always going to have their own bugaboos until they want to invest. Then they're going to they're going to look past all the bad blemishes, and they're going to invest because that's what they want to do, and they're being paid to take that risk.
And the other thing is, okay, well, these guys are doing this. Why aren't we? So there's a groupthink mentality that is definitely in play and will always be in play, frankly, when it comes to deal flow and deals coming in, holistically speaking. The other thing to think about is, going back to the power of the people, the Jobs Act changing things, these capital raisers can come in, raise meaningful dollars. It's like, well, I think the deals that are going to do best are kind of the deals that were done the first half of 2024, dare I say. There's merit to believe that that is actually the case. And guess what a lot of groups weren't doing? They were doing prep positions, or, just weren't investing straight up. And who were investing? Groups like us, frankly, and groups that were, or buying, I should say, and who are our biggest sources of capital. It was more of the kind of boutique, as I mentioned, fund to fund manager. Groups were not putting up money then. Deal flows were not as plentiful. And granted, we don't know where things are going to go, but I think you can make a very strong bid that the cap rate high has happened. And, naturally, that is a great time to start buying. That's basically saying and signaling that the cycle is restarting. And, being early there is awesome. So I look forward to the outsized benefits that we're going to get from the deals that we bought this year.
Yeah, fair. So I think the problem about cash on cash is we're not going to see good cash on cash returns, I think, pretty much ever.
So
And
you think the yields are going to go? So what you're telling me and what we're saying here, crystal ball Rob is coming out to play right now, is you think moving forward that just because the space is so much more competitive, so much more institutionalized, that the a little bit of alpha and the cash flow is going to compress because, to that point, I remember people hearing and talking about how, oh yeah, well, I used to be able to get positive leverage on anything in any market. Well, that's not so anymore. You're not doing that in Dallas. You're not doing that in South Florida. You're not doing that in Phoenix.
no, if you just look at capital flow trends, you will see that I don't have the numbers in front of me, but it was like as late as the 80s, pension funds had like 6% of, or maybe 3%, or something just ridiculously small portion of their capital allocated to commercial real estate. And then of that, it was all in office. So now real estate has become a huge allocation for institutional investors, for private investors, for everybody. Everybody wants to invest in real estate. And then on top of that, where do they want to invest inside of the real estate sector? They want to invest in multifamily and industrial, right? So it's been a big capital rotation. And I think that capital rotation is somewhat secular, which means a long enduring trend. And what that means is it's not cyclical, like the opposite of secular is cyclical.
Cyclical. Yeah,
Yeah. And so I don't think the money is just going to run away from multifamily tomorrow. I think this money is here to stay. Multifamily has become an institutional asset class, and it's just going to have different fundamentals because of that. And so if people are going to hold out hope for buying Class A deals at a 6.5 cap and hold out hope for generating 8% cash on cash returns in a growth market, I say good luck, because I don't think it's going to happen, because there's going to be groups who are going to outbid you, like us, because we're going to be willing to pay more and accept lower returns. And it's not like we're the most competitive group out there. There's other groups who are willing to pay still more than us because they're willing to bet on the stability and the future of the asset class. So I think yields are just kind of secularly compressed. So that's kind of a battle in people's minds as well. Like you said, people kind of are stuck to the past, and they're like, well, back in the day, I used to be able to produce X or achieve X. And I think the rules of the game have changed a bit.
for sure. Segueing now, speaking of rules changing, things changing, alpha, being nimble, being open minded, being on the cutting edge, vintage conversation, very tumultuous. Talk about groupthink. Boy, oh boy, is this one the league leader in groupthink? I would certainly argue. What say you on the vintage conversation? And shout out to our boy, Bradley Oliver, our director of acquisitions, for the prompt here. I'm not going to read out the entire excerpt that he had for the thought, but I'll let you lead it away.
Yeah, this is a great topic. So we've spent plenty of time talking about vintage as far as the age of a property. And what's become really out of favor, I would say, over the last 18 months, maybe really only 12 months, is older properties, right? And that's actually the opposite of what was true at the peak of the cycle in 2021 and into early 22. The soup of the day, or the hottest assets, were the older assets that had meat on the bone, where you could go in and do renovations, and people were bidding on these deals super aggressively, and they're willing to overlook the fact that these were old properties, and that you're going to have issues with plumbing, you're going to have issues with foundations and roofs, and so on, right? Old properties are headaches. But people didn't care. People were just bidding against each other, trying to pay crazy numbers because it was a good story, right? Going back to the story concept, investors wanted the story. Back at that time, I remember we were struggling because we were finding some good buys that were a bit newer, a bit less risky in our opinion, and less of a headache, right? Because they were newer projects. But they were actually harder to sell to investors because we didn't have a sexy before and after picture in our pitch deck of like, hey, here's the old ugly kitchen and look at where we're going to transform it into, right? Investors could wrap their arms around that and go, wow, this is great. Of course, this deal is an amazing deal. Look at what we're going to do. We're going to take the kitchen and it's going to look like this with old Formica countertops and no backsplash in the kitchen, old hardware, old lighting package, old
Bad
flooring,
carpet.
uh, paint, and white appliances. And then bang, you look at the after picture and there's stainless steel appliances, granite or quartz countertops, backsplash, and the whole works, right? New cabinet fronts. And so that was attracting investors. And then, of course, that tail was wagging the dog, and sponsors were like, oh, okay, great. That's what investors want. And so they were going crazy. And so now those deals have fallen out of favor. So they went from this all the way to the bottom. They went from the top to the bottom. And
And it
now
was
it's
probably
really,
due to, yeah, it was probably due to, frankly, those deals getting destroyed the most, and also probably to make those deals make sense during the zeitgeist of things, which is probably maxing leverage, doing bridge, trying to hit a home run, shoot it at the moon. Well, when rents went down or rents kind of stayed flat, and things weren't going up 20%, the return on cost got thrown off, the leverage point got thrown off, and cap rate expansion hit them in the face. It was a perfect storm of things that really made those deals probably fall out of favor to a certain extent. Would you agree?
well, what goes up must come down. And what went up the most is susceptible to going down the most, right? Because it was so hot and got bid up so much, it had the most room to fall. And basically, pricing and fundamentals were decoupled the most in that segment of the market. Yes, of course, brand new product was overpaid for as well. Everything was overpaid for because everything was being paid for on the basis of much lower interest rates. And so that influenced valuation. So everything was affected by interest rates going up, of course, but there was a decoupling between pricing and fundamentals the most because of just investor fervor, right? Everyone wanted it so much. So now the opposite has happened, right? Investors don't want anything to do with older properties. So you're talking about 70s properties for sure, even 80s properties. A lot of investors have been chastened by past experience, and they're saying, well, I invested in an 80s deal and it didn't go well, so I don't want 80s deals anymore. I heard on another podcast that 2000s deals are the way to go, and those are nicer, newer, less risky, so I want those deals. So it's just been a total rotation in investor sentiment and desire. And like with anything, you can take it too far in the opposite extreme. And so now we feel like today's sentiment is reflective of people being, or let's say older property being out of favor to too far of an extreme. Because the reality is there's still value there, right? It could still be a good property. It could still be a good location. Just because it's old doesn't mean it's in bad shape, right? You could have an old property in good shape, and you could have an old property in bad shape. Now, I think we've talked about this concept before. We acquired a property in Dallas this year that is a 70s vintage asset, and we did our due diligence. We felt that it was in good enough condition. We felt that we had a fair enough budget to be able to account for the known risks associated with buying an older property. And we were compensated by being able to buy it for cheaper. We were getting a great location, and there was upside in the rents. So now could arguably be the time to be looking at the out of favor assets because they're actually priced more in line with their fundamentals, assuming you do your due diligence. Now, the really unique other side of this story that's playing out today is just the same way that older vintage is too far out of favor, newer vintage could be perceived as unreasonably too far in favor. And that could push investors or sponsors to overpay for a property just because it is newer, right? Because a new property, again, doesn't make it a good deal, and an old property doesn't make it a bad deal. Everything needs to be analyzed with nuance. And so the reason why we're having this conversation now is because we recently bid on an opportunity here in Houston where the property was built in 2022. So it's a brand new property, decent location, not amazing location, but okay location. But when I went and toured the asset, it looked nice on the outside, but the interiors, the developer spent no money on whatsoever. Like, I mean, I'm currently here living in one of our properties that was built in 2003. Our interiors
Casa de
here,
Lone Star.
Casa de Lone Star here in Houston, Copperfield, unit beep. Um, this property, built in 2003, has miles better interiors than that property that was built in 2022, right? So if you're just like a desktop underwriter underwriting the deal from your computer, you're like, oh, well, it's a 2022 vintage deal, 150 a door. Oh my gosh, that's an amazing deal. Of course I should buy that, right? Well, if you tour it, you see the location for what it is. If you tour it, you see the interiors and you see it for what it is. And you look at the interiors and you go, well, these aren't nice interiors. Okay. But okay, fair. Let's say it's not an amazing location. And so the demographic there, you're not going to necessarily get your money's worth by having really nice interiors. But here's another problem that you have to consider. If the developer who built that property was willing to build a brand new deal, 2022 vintage, with that crappy of interior finishes, then where else do you think they cut corners when building that property? Where you can't see it, right? I'm not talking about countertops. Countertops you can see. I'm talking about structurally
Yeah,
and
and the integrity of the property, the materials here,
that's
the
right.
materials there. Well, I know it's actually very funny you say that because people also conflate new construction or buying a new home from like a tract home or something like that as a good deal. But I've sold new construction houses before, similar to your point, that hey, that's great. I don't care. There's not, plumbing that should be here. This is not right there. The shower is messed up there. So that's why there's warranties on some of these things, quite frankly, right? But to your point there, we could have gotten that deal on contract, done the due diligence process, and be startled. That deal might have worse problems than our beloved Granite Riviera deal that's a 70s built, but hey, it's very functional. There's been improvements done over the course of that deal's life cycle, and we felt very comfortable to accrue that. So to your point, it is nuts. It is nuts that not all of that's the same. There are corner cutting, and quite frankly, guess what also happened? That person could have been feeling the pinch and kind of seeing interest rates rise, like, oh shoot, I better start cutting corners here and there, otherwise I'm going to lose my hat. And if I'm going to sell for 145 a door or 150 a door, with it being, all bells and whistled out, or with it being kind of crappy, well, guess what? I'm going to sell it with the latter. I'm going to sell it with the crappy kind of setup, this that, because I need to save my shirt.
Yeah, anything's possible. So I think the challenge with that deal and the reason why we walked away from it was just because people are willing to pay more for the asset, in our opinion, overpay for the asset simply due to the age of the asset. So that's why you always want to do an extra layer of due diligence.
Yeah, they like the first and third letter in that vintage, right? So, it's unfortunate, but not all deals are created the same. Not all construction people are created the same. The builder, if you're buying a new build, certainly does matter. And, you can lose your money on a new build. You can lose your money on a 60s deal. You can lose money in any sort of real estate deal. I think everyone's kind of realizing that right now if they put the wrong debt and equity structure on and they don't see and read between the lines on the nuances. Life is in the nuances, the gray areas. Not everything is just black or white. So I think it's very important to kind of assess that with any investment that you make naturally. Final subject here, something near and dear, and I actually want to do this so I don't steal time away from your precious personal life and business life, although we talk all the time anyways, so it doesn't really make a difference. But for the people, we need to start talking about and get on to the suit supply. So there's something that we have a phrase for. It's kind of that in-between look. It's not a suit, but it's not, the golf polo casual, if you will, that you're wearing, that I'm sporting right now, of course, too, which is the in-between look, the sports coat look. So I have a question, and we might as well go through a, kind of a mock draft, if you will, kind of an exercise here. So if you want to pull up the Suit Supply website and kind of go crazy with it, I am in the market for a new sport coat. What direction? I don't know what to go with. But for full context, what I have currently in the inventory for that is a nice blue sport coat, custom made, full canvas, of course, and then some gray stone trousers. But with that said, I want to upgrade here. I want to get a new sport coat. So with that said, what is the direction I take from that point on that suit? Simple. You can stick with charcoal and navy. Then you go to pinstripe or something like that. And you get a couple different dress shirts, 5 ties. Now you've got 20 different combinations. Sport coat look, harder to pull off. What say you?
Yeah, so let's just lay the foundation and say
Does the suit
that
come with a hairline as well? Because if it is, I'll buy everything they have in stock.
yeah, it's not too shabby. So the so wearing a suit's actually very easy. Now I know, of course, a lot of people listening don't wear a suit every day, and look at us, we're guilty of not wearing our suits every day. But in New York, we're wearing our suits every single day, and I think putting on a suit and tie is actually super easy. It's really easy to look really good, right? You literally wear a dark suit, you wear a white shirt, black shoes, and a nice dark tie, and you look like $1,000,000. The challenge is when you want to dress down, but you still want to look really nice. And that's where we, like you said, talk about the in-between look, where like this gentleman here is even wearing blue jeans, but he's paired it with here a crew neck sweater with a sport coat, and it looks really sharp. So this is where it takes a lot more thought and a lot more skill, and it's frankly much more intimidating. So to break it down, and then we can kind of talk about you as the example. The key components when you're looking to put together these sorts of in-between looks is, and this is the reason why it's much more complicated, is because now you need to buy two pieces instead of one. When you buy a suit, you're buying one piece. Right? It's a jacket and the trousers, and it's one fabric. Now, when you're pulling off the in-between look, you're talking about buying trousers and you're talking about buying a sport coat. And so it kind of requires some more thought here. Let me see if I can find a better page. But so you kind of need to buy both. And so what I would say is, let's start with the jacket. The first thing that you want to do with the jacket is you want to get something of like a navy, because it's the most versatile. So let's just scroll until
Oh,
we find
since I
something
already
that is.
have, and sorry to cut you off there, but I already have that bird's eye navy coat, which can actually be more versatile than I think we give it credit for. So I kind of already have two blue looks, two navy looks. So do I go with kind of a checkered look? Do I go with something like that? Do I go with maybe a green or a red look? Do I go with cream? Like what is my true direction here? Because I can kind of take it really in many angles, if you will.
Yeah, so you're ahead of the game of many, right? Because you already have a really nice, I would say, medium blue, medium navy sport coat. And like I said, it's very versatile because you could dress it all the way up with like dark gray trousers and then that medium blue sport coat with a little bit of texture. And you could even wear a white dress shirt with a tie. And you're basically, like, for all intents and purposes, wearing a suit. Like, it's very formal. And then you could go all the way the other way and you could dress that same jacket way down. You could even go jeans, although I'm not a super big fan of jeans look. You could do jeans, loafers, t-shirt, and then with the same jacket. So it allows you to wear such a wide spectrum. So I think it's critical to get that plain medium blue sport coat first. And then now where you are, you have the opportunity to potentially do something like this, which has a pattern. I think this is great because it's still a 4 seasons jacket, meaning you can wear it in the spring, summer, winter, fall, and it's more casual. Like this when someone sees you wearing this screams like, okay, this guy knows what he's doing. It's not his only jacket that he owns, and he actually is intentionally wearing something nice. He's not just forced to wear a suit and he's doing it because he has to. He's doing it because he wants to. It's kind of like the pocket square concept, right? If this guy just added a little pocket square here, it would further speak to the fact that this person is dressing up because he takes care of himself and he's doing it because he wants to, not because he has to. The other way to think about it, like we joke around, is you're dressed up not like you're going to the office, you're dressed up like you own the office.
The duck may sit on the lake, but my daddy owns the lake. Shout out to the
Precisely,
movie Holes, if you're wondering.
precisely. So
I
a
like that light
big
little thing, that light little John down there.
this one?
No, yes, yeah,
No,
I kind
no, I
of
don't
like
really like.
that.
I like something more like
But
this.
the
This is
issue
really
is, but see, the issue there, in my perspective, is that's not your second sport
no.
coat. That's like your third or fourth. So to your point, intertwining it and kind of connecting back, that little check pattern before was perfect. I would love something like that. That would be something really solid. And then one of the gentlemen from Rogers Gray had a really nice look as well on the pod that he had that I really liked as well. If you want to maybe, you'll cut back to the episode 2 weeks ago, you'll see it.
The, yeah, you should go back to the episode a couple weeks ago. You'll see some good sport coat examples. This is a great sport coat, actually. It's got a nice pattern, but the pattern's not too loud where if you wore that jacket again a couple days, a week later, people aren't going to be thinking, oh my gosh, I remember when you wore that jacket on Wednesday, right? So that's something you have to keep in mind. The louder the pattern, the more distinct the color and pattern of the piece, the less usable it's going to be. And I personally just love owning clothes that I can wear every day and not really have people notice too much. So,
See, to your point there, that's why the more navy kind of check look before was solid. So I would kind of go with that. Something probably exactly like that, or maybe that one right there is
mhm.
something that's solid where It's more everyday. It's darker. Not too okay. Hey, well, if you wear that little piece right there, that kind of light one 2 days in a row, okay, well, you're gonna notice that. But if you wear a navy thing 2 days in a row, if you put different pants on, no one would know the difference.
Right. So we're kind of venturing into riskier waters here. And so if someone's listening or if you're thinking about making your next purchase and you're going to go to Suit Supply, what you're going to do is you're going to walk into Suit Supply and they're going to have the flashy branding and the artwork, and you're going to have sales guys and there's going to be cool new stuff on the wall. And
There's gonna be cool music in the background. You're gonna get intoxicated by the
you're
moment
going to
and
get
make a very
intoxicated.
trendy decision. Yeah.
And guess what? It's all seasonal stuff, right? Because Suit Supply, although it's a fantastic company that I love, they're in the business of making money just like everybody else. And so what they want to do is they want to convince you to walk in and buy the latest trend and buy the latest seasonal stuff. And that way, when you come in again in a couple months, they want you to buy some more, right? So there's going to be this natural current pulling you in the direction of buying things that are trendier and less timeless, right? Because if you're buying the trends, you're going to be spending more money, right? If you walk into Suit Supply and you say, "Hey, I'd like to buy a jacket so I can buy this one jacket and I never have to shop from you again," that's not a good business model for them. So you have to actively be fighting against that current and be specifically looking past kind of what's on the rack and what's being recommended, and think and just kind of stick to your guns, stick to the roadmap of buying a timeless interchangeable wardrobe. So that's just something just at a high level to keep in mind, right? Like instead of buying that classic dark navy two-piece single breast suit, they're going to say, "Oh yeah, buy the flashy wide peak lapel double breasted double check and stripe and this pattern and blue and green," right? So you have to just be careful about that.
There's a lot of
But
options, but I think at the end of the day, the moral of that story is stick to the classics because classics are inherently classic, and something that's classic will never go out of style.
yeah, so I would
But hey,
definitely do
why is
just
a diamond earring or a pearl necklace, always, probably a good choice if you're buying something for your wife? Well, because guess what? Those that were in style 100 years ago, and they'll be in style 100 years from now as well.
So these are some great options here, right? Like after you buy like your basic one with no pattern, getting a pattern like this is not too loud. That's super handsome, really great options. And then once you kind of get the blue navy-ish thing done, then looking at something like this is taupe or like like a light brown
A
or
linen,
like
perhaps.
camel, like for summer, those are really fantastic options. So then you have to solve the bottom side of the equation, if you will. Right now, you've got your amazing new jacket or two. You're super excited. Now, what do you wear it with? Right. Well, you don't just take the pants from your suit and then put your new jacket on top. Right. You need to actually do some trousers. And so, a great pair of trousers, if you, on the more casual side, would be something white like this. So white bottoms are great because they go with everything, right? You could wear a light gray jacket like this. You could do even like a light brown. You could do the navy. So white trousers work with everything. It's great. It's just very casual. So you're going to be slightly more limited when you can wear it. So the darker you go, the more formal, of course, for the trousers. So getting a good pair of navy trousers, getting a good pair of charcoal trousers, really fantastic ideas. And that will provide the base for you to have fun with the jackets. So I don't recommend having fun with your trousers really at all. I think your trousers should just kind of blend in, whether you go with like charcoal, navy, and white. I think those are the best ones to get. I know that I just got a pair recently of really cool kind of sand light brown trousers. I think those are also really fantastic that work very
Mm-hmm.
similarly to
Mm-hmm.
white. So let me see if I
Mm-hmm.
can find something like that.
And by the way, you'll note, of course, that gentleman there on the bottom left of the screen, he's got the more baggy pant look right now. That's very trendy. That's very in vogue. That will be here today and gone tomorrow.
Yeah,
And something
exactly.
like that right there, top one, normal, that'll probably be in style indefinitely.
Yeah, so these are all really great options for trousers. I would stick to, again, more like a Four Seasons fabric. There is definitely a time and place to have like flannel trousers, so like a heavier flannel feeling wool that's more for winter. But I would, as your starting point, definitely get something that's just wool and Four Seasons. So again, you can wear it all year round, so it's more interchangeable. But yeah, these are all good options for dark trousers. This is a fantastic option right here. This is the sand. again, I would not do the cuffs whatsoever. And I would actually, these pleats aren't terrible. This is all fine, but I just wouldn't do the cuffs because cuffs are very formal. And this is a more casual look, right? These are sand trousers that you're going to wear without a tie, not a suit look, right? Perhaps even without a jacket. So I think the cuffs do not belong. But this is the problem, right? It's coming with the cuffs, right? Because they want you to buy the cuffs because they're in style now and then they're out of style later. So it's worth it to spend the extra money or to be patient to buy what you really need and want rather than buy the trend, right? And so when I say spend the extra money, just make it custom. If you're going to go to Suit Supply or wherever else, go in there, spend the extra money for a custom order so that it's made exactly to your specifications so you can wear it forever.
I love it. Any other items to conclude this conversation?
No, I think we spilled the beans on that pretty well.
Good. Well, we save it to the end. A little bonus for the fashion people looking to make ever important decisions on that front. Thank you so much for your time today, for listening. Rob, a pleasure as always, and we'll see you next week.
Peace.